There is a way of using momentum indicators that seems completely logical. The RSI crosses below 30, buy signal. It crosses above 70, sell signal. The stochastic drops into oversold territory, get ready to go long. Simple, visual, repeatable. The problem is not the indicators themselves. RSI, stochastic, CCI, TSI, these are all legitimate tools. They measure something real. They have genuine value in the right context. The problem is the way most traders have been taught to read them. The common interpretation is built on a reasonable but incomplete idea that an extreme momentum reading predicts a reversal. And when that idea drives a decision, the trades that follow are built on a foundation that does not hold up in real markets. Now, I've seen this pattern across years of trading. It's not a discipline problem, and it's not a knowledge gap about the indicators themselves. It's a framing problem. The trader understands what the tool displays. What they have not yet built is a clear model for what the tool actually means. Now, I wrote an article on this at positionforex.com, and it's linked below. It covers the 4 major momentum indicators and explains how each fit into a complete approach. In this video, I want to focus specifically on why the standard momentum interpretation fails, what the correct framing is, and how position traders should be thinking about this. So, let's walk through it carefully. The logic behind reading overbought and oversold conditions as trade signals is straightforward. Momentum indicators measure the speed and energy behind recent price movement. And when that energy becomes extreme, when price has moved aggressively in one direction over a short period, the indicator enters an overbought or oversold zone. RSI above 70, stochastic above 80, CCI above 100. The common interpretation is that price has moved too far, too fast, and that a correction or reversal is imminent. And from there, the trade logic is simple. Sell when the indicator is overbought, buy when it's oversold. Wait for the reading to cross back through the threshold and enter in the opposite direction. Now, this approach appeals to traders for legitimate reasons. It gives a clear, objective signal. It removes ambiguity. It creates a rule that can be applied consistently across any pair or any time frame. And it's based on real observation. That price does, in fact, frequently pause or reverse after reaching extreme momentum readings. The appeal is also visual. Momentum indicators are easy to read. The lines move clearly, the thresholds are marked. It feels like a system that removes guesswork from the decision. And none of this is wrong at the surface level. Extreme momentum readings do carry information. Overbought conditions do sometimes precede reversals. And the observation is real. The problem is how that observation is being interpreted and what is being left out of the analysis entirely. The core flaw in the standard approach is treating momentum reading as a standalone event. In reality, a momentum reading has almost no meaning without knowing the broader context in which it's appearing. And the most important piece of that context is the trend. In a strong trending market, a pair making consistent higher highs and higher lows on a weekly chart, momentum can remain in overbought territory for a very long period of time. The trend is in control, buyers are continuously active, and every pullback is followed by a resumption of that move higher. In that environment, selling because RSI crossed 70 is not acting on a signal. It is repeatedly acting against the dominant market direction until something changes. This is where the logic stops scaling. The overbought reading in a trending market is not telling you that price has gone too far. It indicates that the trend has significant momentum, and those are very different messages. Treating them as the same message produces a consistent series of trades that are technically entered on a signal and logically misplaced. Divergence carries the same flaw. When price makes a new high, but the momentum indicator does not confirm it, many traders read it as a reliable warning of an impending reversal. In the article, I address this directly. Divergence is possible, but it's unreliable without the broader market context to support it. I have seen divergence appear and persist for weeks, while price continued in the original direction. The divergence was real. The reversal was not imminent. The breakdown happens because momentum indicators are lagging. They reflect what price has already done. They are not telling you what price will do next. When they are used as predictive signals, they are being asked to do something they were never designed to do. The way I think about momentum is fundamentally different from the signal-based approach. I don't look at a momentum reading and ask whether it's overbought or oversold. I look at it and I ask, what is this reading telling me about the current energy state of this market? And how does that fit within the trend and the key levels that I'm already seeing? That shift from signal to context changes everything about how the tool functions. When I see a momentum indicator pull back to neutral within a bullish trend, I don't see a sell signal. I see a potential reloading point. The trend is intact, the short-term energy has cooled. I'm now watching for momentum to turn back upward, ideally at a meaningful level of support, as a sign that the trend is resuming. That combination carries weight. The momentum reading alone does not. I use momentum as confirmation of what the trend and the key levels are already suggesting. The trend gives me direction. The level gives me a zone. The momentum turning at that zone confirms the energy is aligning with the case I've already built. Take away any one of those three things, and the case becomes significantly weaker. This also changes how I read extreme readings. When the RSI is in overbought territory inside a strong trend, I'm not looking to sell. I'm recognizing that the trend has significant energy and that I should be patient for a pullback to develop before looking for a re-entry. The overbought reading is useful information. It just does not mean what the standard approach assumes it means. Every indicator I use, RSI, Stochastic, CCI, TSI, measures a slightly different aspect of price energy. Knowing what each one measures allows me to weigh their signals appropriately based on the market environment I'm in. The signal-based approach to momentum persists because it's easy to teach and it's easy to remember. Overbought means sell, oversold means buy. That is a two-word rule that anyone can learn in a few minutes and apply immediately to any chart. It's visual, concrete, and it requires no additional knowledge of trends, market context, or price behavior across time frames. The accessibility of that rule is what keeps it circulating, and it gets passed from one trader to another because it's simple to communicate, and in certain market conditions, particularly in raging markets, it often produces results sufficient to appear valid. When price is moving sideways and bouncing between levels, overbought and oversold readings can function reasonably well as reversal signals. The problem is that traders build their entire momentum framework around behavior specific to ranging conditions and then carry it into trending markets where it does not apply. There is also a visual confirmation bias at work. After the fact, it's easy to look at a chart and find moments where an overbought reading was followed by a reversal. Those examples are real and easy to spot. What is harder to see and what does not get shown in most educational content are the extended periods when an overbought reading was followed by a continuation, not a reversal. I'm not suggesting that traders use this approach or that they're doing something careless. The framing they received was incomplete, not wrong, at every moment. The issue is that an incomplete framing applied consistently across all market conditions will produce inconsistent results. And the trader never understands why, because the signal was technically there. At the position trading level, weekly and daily charts, momentum deserves more weight than it does at lower time frames, but only when it's being used correctly. A weekly RSI reading reflects weeks of accumulated price behavior. It's not noise. It's a meaningful representation of energy behind a sustained move. That makes it a genuinely useful input when placed within the right analytical framework, one that already accounts for trend direction, key price levels, and the broader macro environment. The way I use momentum at higher time frames is specifically for entry timing within an established trend. I'm not using it to identify the trend. I'm not using it to predict reversals. I'm using it to identify when a pullback within a trend is losing energy and when that energy is beginning to shift back in the trend's direction. The specific pattern I look for is this: trend established on the higher time frame, pullback underway, momentum neutral or slightly against the trend, and then momentum beginning to turn back. When that turn occurs at a meaningful price level and candlestick behavior confirms the shift, I have a confluence of factors pointing in the same direction. That is very different from a single indicator crossing a line. At higher time frames, patience is what allows this to work. The setups take time to develop. The daily chart momentum shift does not happen in an afternoon. Watching it unfold over days and weeks and waiting for the full confluence before acting is a discipline that separates this approach from the single-based model. Momentum also needs to be set aside during major news-driven moves. A spike in a momentum indicator caused by a central bank announcement of a major economic release does not tell me anything useful about trend energy. It's reflecting a temporary disruption. I do not trade momentum signals in those windows. The reading is real, but its cause is situational, not structural in any meaningful analytical sense. The core reframe I want to leave you with is this: momentum is not a prediction, it's a measurement. It shows you what price energy has been trading at recently. That is genuinely useful information, but only when it's placed alongside everything the market is telling you. When I removed the idea that overbought means sell and oversold means buy from my own framework, my use of momentum indicators became significantly more coherent. Not because I stopped using them. I still use the RSI, the Stochastic, CCI, and primarily the TSI. But because I stopped asking them to answer a question they cannot answer, which is what price will do next. What they can answer is whether the market's current energy state aligns with the case I have already built from trends and key levels. That is a much more limited question, and it's the right one. Position trading gives you the time to be patient with this. You're not watching 5-minute charts and making fast decisions. You have time to let a setup develop, time to watch momentum shift, time to wait for confluence before committing. That patience is not a constraint on your trading, it's your edge. The complete framework for this video is available at my article at positionforex.com. Momentum trading, 4 strategies for your arsenal, and it's linked in the description below. It covers the RSI, Stochastic, CCI, and TSI in depth, explains how overbought and oversold conditions should be read in context, and walks through how I combine momentum with trend, key levels, and candlestick analysis for higher quality entries. It's a reference piece designed to stay relevant throughout your development as a position trader, and until next time, best to your trading.